So here's how I want to start this. When I ventured into the real estate business
Yeah.
and discovered online influencers in real estate, in the beginning, I was kind of thrown off because I would meet people and it would feel like they actually had no idea what was going on. Like they weren't actual business operators, real estate operators. They were content creators. And then I discovered you. And when I met you, it took 5 minutes and I went, okay, this is the real deal. Like your understanding of real estate is only because you actually do this day to day.
Yes.
And I love the conversations that we've had in the past. So what I want to do in this episode, for anyone who doesn't really understand commercial real estate, we can focus on multifamily or storage. I want them to really know what's going on right now because we started off this conversation before we turned the cameras on how good real estate investing is right this second.
Yeah.
And simultaneously, we're seeing so many people go, not right now.
Yeah.
So that's my goal for this
Sounds
conversation. So on storage,
Yeah.
when has there been a better time since you started investing than right now?
2000, really, right after 2009, 10, 11, and 12. And even by better, I have to be careful with that because the deals that we were buying were not better quality. They weren't better location. So the deals that we're buying today are much better quality. They're much better locations. These are institutional grade, well-built assets, high quality, but the price point and value that we're getting them is similar to that time period. And that is something we have not seen. Even if you go back prior to 2008 when we were buying, there was such a lack of anything institutional quality that even when you were getting a decent deal, it was not like the assets we see today. After 2008, we could still get large deals, but most of it was still just your traditional drive up, 100, 120,000 square feet. We were getting a great entry price, obviously because of the crisis. And so the basis was low, but at that time, occupancies were really low. And there was a lot of questions around storage. It was harder to finance, and the tools to actually use and turn assets around and be in it were less. Today, that's all different.
That's actually a really good point because from 2000, 2008, there wasn't a lot of faith in storage at that time.
Oh.
It was kind of newer.
It was very much seen as risky. When we went to get a loan out on a deal, the banks didn't even view it like traditional real estate. They were like, you got to guarantee all of this because we don't know if this is literally a fad, if this will be around.
Yeah.
Less than 10% of the industry was institutionalized. Banks didn't like it.
That's
Yeah,
right.
we saw the same thing. They had no idea how to underwrite storage deals at all.
Yeah.
At all.
The
Scared
storage
them.
deals that you were buying up then and maybe even till today, they are already built, stabilized, existing product.
Yes.
Okay.
Yeah.
Yeah.
Yeah. So
We're
That
doing
was a great
development
time
now,
back then to get into it.
But yeah, back then it was an amazing time to get into it. But also there were huge challenges to get into storage because we were in a banking crisis and you had an industry that already thought storage was risky.
yeah.
So the actual execution of it, our main method of turning around a facility was actually put it online, like make a website. So the infrastructure in the industry to support storage was really, really low. There was not a lot of tools. It was much harder to manage out of state. So even though maybe the entry price was really good at the time, operationally, financing, it was really difficult, much more than today.
Yeah. And I think our numbers actually support that. If you look at the deals we did back then when it felt like the Wild West, those deals from a return standpoint have been through the roof.
Through the roof.
And then anything that was like post 2015, not bad, but not like those.
Not like those.
No, we went on a crazy buying spree in 2012 to 15.
Yeah.
Yeah.
Us too.
Yeah, but it was not like the Saticoy deal. That was, we were early.
Yeah, that one, you're talking about 27 years ago.
Yeah. So you brought up a point that actually I want to touch on, which is quality.
Yes.
And spend some time on this. Most beginner investors actually, I think, focus on price and what they can buy and not necessarily quality.
Yes.
So let's start with this. Is it wrong to look at what you can buy? And should you just wait until you can get something good, or can you still make money buying a crappy storage unit that's old and drive up and small?
Price does not equal value. And that's the first thing everybody has to realize. So just because it is cheaper doesn't mean that it's safer.
Yeah.
So you can buy a deal that's worth $800,000, but it may be a really bad deal compared to one that's 1.5 million. Price doesn't equal risk. So just because you've invested less doesn't mean it's less risky. It just means the amount of capital is less. And a lot of people get that confused. When you look at storage and other assets, there is a lot to say about more units you have and your overall margin and how much you can make in a particular market versus not. So a lot of people get in a bad spot because they think price equals value and the amount that you're buying in equals whether it's risky or not.
Right.
And that's not true. So you have to be really careful. Now, to buy small facilities, though, can you still make good money? Absolutely. And right now, especially because cap rates have gone up so much. So the value of assets in fourth tier, third tier markets that are under 50,000 net rentable square feet, there's no real exit for these people. And so you have what is by far and large baby boomers that own them that have been trying to retire for 4 years, but what they want for it, they can't get. They're finally releasing the assets. So the last 3 years, just transactions disappeared because they weren't willing to sell them. They thought it would turn around or come back. We're seeing them now go, we have to make a decision, we have to sell. So those assets, you're getting at a really high cap rate. And so you can find really good deals, but you do have to be careful because there is a lot of risk when you're in markets that are easily overbuilt and there is a cap at the revenue, those achievable rates in which you can get. And so the smaller a market is, the easier it is for that market to be oversupplied and the harder it is to come back because there's only a certain amount of people. Now, one of the best things for smaller markets today that's happening is what I call the rate runway. So there's a point where rates will get to where it makes sense to develop. Well, development costs have not come down, but occupancy and rates have. That has just killed the development game in most of the markets in the United States. So because they're not able to put new supply on the market, you have a lot of third, fourth tier markets that are undersupplied and rates need to double before you can actually get anybody to come build because the building cost is so high. So that's a good spot to be in. If you know that you're getting a low basis, a high cap rate, meaning a high margin, because that basis that you pay lasts forever. The interest rate doesn't, right? We all know this. The interest rate will change, but what you pay doesn't. So to pay a lower price at a higher interest rate in a market that can't have new supply, that rate runway means that rates have a lot to go up before new supply will come into the market. That's a great position to be in.
Yeah.
Sorry, go ahead.
That's a really good point because right now we started this off talking about investor capital and people are asking more questions and making there's a longer period of time before a decision is made. And I would say one of the most asked questions I'm getting right now is around interest rates. How are you hedging against interest rates? And I think what you just said actually perfectly explains it. Interest rates aren't always a big factor. They don't necessarily need to be.
No.
And the lack or the inability to add supply is a big factor. And we talk about that often. When we're looking at storage, we're looking at city councils and going, how easily do deals get done with them? Do they say yes to everything? Because then you have to expect that if they say yes to you, they're going to say yes to the 10 other groups that are coming in behind you. And then you run the risk of saturation.
The number one threat to storage is self-storage, bar none. I've got a development deal that we've been working on for 3 years to get out of the ground. And everybody is like, geez, that must be killing you. You must be really upset about it. I'm like, yeah, I hate the time. But at the same time, I love to see it. Because we're going to put this thing out. And I already know nothing else has been built. Anybody that even wants to come try, they've got years, if they can even get it done, to get it. So there are huge benefits with that struggle because I would rather have a market that has high barriers of entry to develop than have a market that, we got development done and quick and easy in a short amount of time, because it was just so simple to do. Well, that means that that market is really subject to being oversupplied, and you can't fix that when it happens.
Yeah, it's interesting you say that, because that was a primary motivation for so many people to move money into like Texas and the multifamily side over the last 3 or 4 years, thinking, oh, it's so easy to build here. This is the place where you want to invest. And now a lot of those investors are getting hit hard because the market is so oversaturated.
Well, it's so interesting that you just said that, because what I was going to say is I think there's a inverse correlation that happens with investors, which is we know that we want to be in areas that have high barrier to entry. But it seems like the high barrier to entry means longer timeline before investors get paid back potentially. And that feeling for a lot of investors, as we know, is challenging.
Yes. Very.
And then the investors go, oh, you can get this built, get money in my pocket. Yeah, I want that. But then there's an added risk that comes with it that I don't think most of them are prepared for.
Well, because you have to time it perfectly in that scenario, right? Where you go into a market that's got a low barrier to entry and you're going to see money right away. You've got to get in when the market gets to the lowest barrier of entry point first, and you have to get out as the barrier of entry gets higher.
Right. Yeah.
Right? And you have to time it perfectly. And if you don't, which is so hard to do, you're going to potentially lose money on the deal.
Right.
Yeah. I don't want to time markets. I want to build good businesses. Right. And that creates the conditions in which those businesses can thrive are the supply and demand. It's the people that live there. It's the demographics. And we've seen this across markets. We're in over 12 states, and we've had some markets where rates have gone down 60% in those markets in the last 3 years. I mean, absolutely clobbered. And then we've had other markets where they haven't. The entry point that we're seeing is 50% what it was 3-4 years ago. And so as, going through the Great Recession, COVID, you really learn, I can't time markets. And so if you're in a position where that is your game and you're trying to time markets, you better be ready to withstand a drawback, because it's only when it'll happen, it's not if. One of the problems we had is the great financial crisis was so severe. That bull run was astronomical. I mean, it just went and went and went, and people just acted like it would never end again.
Right.
It would just never stop. But then the last, 3-4 years of that, from 2018 to 22, there was an explosion of development. And that's always a sign, you're at the top. And then that makes the down that much worse, because now you have less demand with market conditions. Higher interest rates froze the housing market down. Less people are moving, less demand on storage, all simultaneously while deals are coming out in that environment. And that just makes that get even worse.
Yeah, that's a really good point.
It's hard because the only way you can survive down markets is I look at things and go, there's trigger points where if I have to sell or refinance, I'm subject to the market. If I don't have to do those things and I'm buying an asset that's good, it pays its bills, everything else, I can survive. The other thing you got to do is say, do we have cash on hand? So one of the biggest things we did, it was in 2021 and 22, I actually wrote this big thing called the self-storage bubble. I'm like, guys, this is bad. This isn't good. We went and refinanced our whole portfolio, and we just stashed a whole bunch of cash because the printing from the government that was going on, we're going to have inflation here. And that allowed us to survive those down markets and to not get in trouble, right? When you're so subject to interest rates in a lot of these deals, especially new deals and new development, that when those fundamental assumptions change so dramatically, it just kills your ability to do the deal. So most of the deals we're buying right now, we're buying CO deals or newer deals that have come out. The occupancy rates are lower, interest rates are 3 times as high. The bank's like, all right, your underwriting, our underwriting, everybody's underwriting's so far off, you got to come up with $3-4 million. Now, you got to bring that to the table to lock into a perm financing. So they're going, all right, I actually was flipping the deal because speculators came in and they didn't actually plan on hold. They weren't operating. Do I want to take my loss, or do I want to now have to put in millions more, to which I don't think I'm going to get a return for them, and they're walking away.
So what you're saying is people just accepting the L.
Yeah, they're accepting the L, walking away. They're like, we weren't planning on doing a long-term hold. We weren't planning on being in it. And when the opportunity or to exit with an L versus put way more money in and double now what we have in it to risk more money, they're not wanting to do that, or even their investors aren't allowing them to. And so they're like, nope, we're just going to walk away, write off the loss, and call it good.
I would say that's what we're seeing on multifamily as well. Very similar. What about, are you tracking any other asset classes outside of those two?
Yeah, we've been really focused on multifamily. And multifamily, when we look at it, the delinquencies with the CMBS loans overall have really accelerated over the last 6 months. And that's not going to stop because we actually have maturity loans that are rising dramatically in 26 and 27. We're talking about a 40% increase in maturity loans by 2027.
These are the people that were doing the 5-year interest-only deals in 21 and 22.
Yep.
They're now coming up for maturity. The debt service adjustment means those projects aren't cash flowing anymore.
Bingo. And unless something dramatic happens with interest rates, and we're not talking about a little, you're talking about people that had a floating rate at 2.5, or they locked in at 3.5, are now looking at 7.5 and 8. So interest rates can't come down to 6 to make it work. That still doesn't work for them, right? So that interest rate has to come down so dramatically, and most of these assets are in places like Texas and others where there's oversupplied anyways. The numbers aren't going to work. And so they're looking at it saying interest rates aren't coming down. We have a ticking time bomb now. We got to walk away.
Right.
We can't put more money up. We can't get the money to put more money. So they're just like, take the L and walk away. And that's accelerating.
So in that scenario where they take the L, they walk away, that would theoretically mean prices come down and buyers would come into the market. However, is a buyer going to come into the market in a market that's so overly saturated?
And
that's the price, right?
Yeah, it depends on the price, and that's been the big thing. What we've seen for the last 3 years is a lot of financial institutions were willing to work, and they were willing to punt the ball down the road, right? And when they were doing this, it was with the expectations that, all right, we'll either have higher rents or we'll have lower interest rates. And those things have not materialized.
Yeah, and rents aren't going up.
And rents aren't going up.
Yeah.
And so at that point, you come with a lot of hard decisions. Multifamily is much easier to track than storage. And we were talking about this a little before. I have to explain to people that when we look at storage, the claim is, first of all, it is the lowest defaulting asset class commercial real estate by far. The numbers are like 0.18 default rate, where multifamily today is almost at 7% default and rising rapidly. But you have to remember that only represents less than 12% of the storage market. All other loans are not able to see. Whereas multifamily, that represents 60, almost plus % of the market. So we can see those defaults. Storage, you can't see them. It's all done locally, local banks, credit unions. So that is not being nearly as transparent. The default rates are much higher. We just don't know what they are because we can't see it. So when we track multifamily, that's a really good indicator to look at storage. What we find is that the default rates in the areas that we're seeing in multifamily, we'll see that in storage. It just won't be public information because there'll be localized banks. But it's a good indication where we're also seeing the pain in storage.
Got it. Yeah, it's funny because I've done this at your conferences. I talk about investing in California.
Yeah.
And I remember in Idaho at your conference, like people looked at me like I was nuts.
Yeah.
And I get it. Like there is an element of doing business here that might sound psycho to most.
Yeah.
But it goes back to the barrier of entry that we were
Bingo.
talking about earlier, that if it's difficult to build, it actually adds as a protection in a lot of ways against scenarios like this.
Yes.
And, how many people passed on us from 2020 to 2023 because they were looking at Texas and the Carolinas and Florida? Mm-hmm. A lot of people.
A ton.
And then now that's like one of the hardest reasons of raising capital today is all of them got spanked. And they're like, I need a break from this.
They don't want to touch multifamily because they got smoked so badly on some of those deals.
And this becomes the problem. That's actually the time you need to be in it.
Yeah.
Correct.
Most investors have a really hard time, and they first of all, they can't survive, but they also have a hard time because the time you're feeling the most pain is the time you need to be buying the most.
Correct.
And that duality of we're struggling, things are hard, I also need to be optimistic and see the opportunities and take advantage. That can be tough. So investors, when they look at it, they go, I'm struggling right now. Why in the world would I invest? And it's hard because that's actually the reason you should invest.
Okay, so do you think that's the difference between the great investors and everyone else? That the great investors have learned that during the times where it just feels wrong to do, that's actually the time to step in, and they've done it enough to have the discipline to do it, and then everyone else just goes kind of towards what they feel? Is that the separation?
Absolutely. 80+% of self-storage syndicators, operators came in after 2018. I mean, we're talking about not only the majority, the vast majority after things got really, really good. What we've seen in the last 2-3 years is they're gone. Right. All of them are just gone. They came in when it was good. Because what the problem is you have a bias, because as things are getting good, you see that they're getting good. So we have a bias based upon the past, and we think that that means the future. So as it's getting good, I have a confirmation to my bias. Oh, this is good. It gets better. Oh, this is good. It gets better. And now I'm going, my confirmation bias is telling me I need to do this because that equals that it's really good. But the fundamentals that actually made it good are no longer there. Then we have the opposite confirmation bias. It's bad. Okay, that's okay. It's going to turn around. No, it got worse. No, hold on here. It will get better. And then you have a third time. Now the confirmation bias, this is bad. I shouldn't be doing this. I need to get out. And that confirmation bias, though, is actually the reason why you need to be getting in, because that sets the stage for the very things that made it good in the first place. This is really, really hard to do. You have to look at just the data, just the facts. When you look at areas, why people went to areas like Texas, they were looking at one input, basically, one input only, growth rate, population growth rate. Along with that population growth rate boom, though, came a supply boom. So I look at what I call transitory occupancy. That is not core occupancy. That is occupancy that comes with that high growth rate. So if you're in an area that has a 4% growth rate, first of all, renters utilize that product that are moving at a rate that is far, far higher than your average person. So that 4% growth rate may represent 100,000 people, but the users are 60% of that. So you get this abnormal, in high growth rate markets, this abnormal demand. But when that growth rate slows down or goes away, it has the opposite effect. It shrinks demand abnormally because you're taking such a big section of that growth demand. That creates the swings in growth markets. So the very thing that drew people to it is actually the very thing that was going to kill it.
Dang.
And people don't see it because they're too caught up in the noise and their emotions.
They're looking at the headlines.
Yeah.
Headlines are confirmation of what happened, not what will happen. They're simply telling you this has happened again and again, and now we're saying it's bad. That doesn't mean that's what's going to happen, right? Just like when it's awesome, the headlines are, this is great, it can't fail. You know, it was right. You go back to 2020, 2021, and it was just how everybody was making money in real estate. You know, Wall Street Journal, best performing asset class, front page storage, on and on and on. That, and right there, you're like, uh-oh.
Yeah. I remember telling him that. I'm like, we got a problem.
We got a problem.
Cody Sanchez has made boring businesses really cool. And then what followed was influencers talking about storage. And I was like, dude, we got away with this for a long time. Now it's, we're going to have a challenge because it's going to increase the demand of people that aren't really looking at the actual fundamentals.
Exactly. Yeah. When you have investors and when you have the supply side that is more excited than the demand side, you have a problem. There was so much hype around the supply side, around the asset, around the product, that it so surpassed the need and the actual demand, it created an imbalance because of that confirmation bias. And then when it goes the other way, that is the great opportunity. There's so much focus on the pain, the supply side is killed. So right now, when we look at storage and multifamily, the new product coming out is just cratered. You can't get construction loans. Investors won't do speculation. They're not doing new construction. So what happens is you have this tail. If I'm oversupplying a market, I have 3 years. When I look at a market and it's doing really, really good, so I decide to develop there, that product doesn't come out for 3 years.
Yeah.
So when it's really, really bad and nobody can put out supply, all of a sudden, by the time it gets good and they want to put supply out, you have 3-4 years till it'll ever come out.
That's right.
That creates abnormal demand on the other side of the cycle because supply is so constrained. When it goes to come out, it's not like you flip a light switch. There's years later. So by the time you need to put new supply out, it's already years later. There's pent up now demand, and it takes years for the new supply to offset it. Occupancies and rates rise dramatically.
Yeah, that's right. That's actually something that we're spending a lot of time talking to investors about.
I mean, we're feeling it.
Yeah, we're feeling construction is halted here.
Yes.
It's completely halted.
Yeah.
And so the question becomes when it turns on, what happens? And I think naturally, if you're not in the real estate world, you just think, oh yeah, it turns on like that.
Turns on and you got it.
But it's the delayed reality of 2 years to
Yeah.
build it. All of the time that goes into your permits and entitlements before you know it,
yeah.
you're 5 years out before the product's
Absolutely.
realized. So we've always talked about we want product online, brand new, once everyone starts to say yes, because then they
Exactly.
still have a bunch of time till it's realized. But I'm not going to lie, it is uncomfortable being in that scenario. You're like
Yeah.
looking around going, we're the only ones?
Yeah.
No
we
one
put
else?
out 2 big developments in the last 6-7 months. The one that came out, our most recent one, we are at 70+% occupied the first year.
Wow.
There's been no new supply in that market for 4 years.
This is a
and
project
there's
you
nothing.
developed?
Yeah.
Dang,
Project that
those
we
are
developed.
crazy numbers.
Oh, crazy. And there is not one project on the books in that entire city at all. And when you look at that, where the struggles are on the interest rates and that cost that you have to pay, but the supply side is good, the numbers are going up, and because there's no new supply, that means rents are going to rise too. And the basis that we're getting into them are so low that spread works. And once again, I would rather do that and then adjust my interest rate when interest rates come down than go the other way.
Yeah.
Because those are the real fundamentals. Those are the economics of the deal that make it actually work. And so we've got the other project we did, which was massive, 200,000+ net rentable square feet. And we're not even at the first year. That's already over 50% full.
Well,
These are
that's
massive
really
deals.
fast.
Yeah.
That's insanely
Really
fast
fast.
for self-storage.
Yeah.
I mean, just for context, for anybody who doesn't know, ours take about 4 years.
3.
Yeah.
3 years to get
Three,
full
Takes,
stabilization?
takes about 36 months to lease up about 1,000
Oh,
units.
3. That's right. That's
Yeah.
right. I'm thinking about how long it takes.
So
to get
I'm
to
assuming
refi out.
200,000 at rentable, you probably like 1,900 units.
Yeah, that's about right. We're about 1,400 because we have some larger units. But
Okay.
yeah, that's right.
So to get to 50% occupied in how
that's
long?
a massive, under a year, 6 months, I think we hit 50%.
Yeah,
Psycho.
I mean, that's just a testament to when you lack supply in the market, you have this pent up demand. And so you put product in the market and the demand goes to it.
Yeah, that's
This is so it's so interesting because how much of real estate really comes down to basic economics.
Yeah.
And people are thinking of all the other variables and they're just losing sight of the basic economics. When you have limited supply and excess demand, that's where you go. And when you have excess supply and limited demand, that's where you stay away. It doesn't have to get more difficult than
Well,
that.
yeah, I think that's what's so nice about real estate is that you can look at something so basic as supply and demand,
Yes.
right? Like you look at other sectors or even like startups, a lot of it you are kind of taking a moonshot on. Like it's a guess, it's a build it. I hope they're there and they'll come. Maybe there's some data, but with real estate, you're inside of a box, which does cap your upside. Like you're not going to get a 14x multiple in 3
Yeah.
years, but you can be more sure on the bet you're making because you are looking at, somewhat simple fundamentals. For you, what are the hottest markets, or maybe where are the best markets that you're looking at right now to invest in?
So right now, Texas, which is funny because I tried to invest in Texas for the last 10 years and I couldn't ever do it because I'm like, these numbers don't make sense to me, even though the growth rate's there.
I was not expecting you to say Texas.
Yeah,
Where
Texas.
in Texas?
Dallas, Fort Worth, we're buying a lot because the basis is so low. I can buy them up today far below than I could build them for. So we've got we just closed. We just bought 2 in Iowa, Dallas, Fort Worth, 3 more, and we're buying at probably the 2 in Iowa are almost 50% of replacement cost, and in Dallas, we're at probably $122 a square foot.
Where in Iowa?
Which
You saturating our market? What's up?
oh, you in Iowa
We
too?
have one in
Nice.
Iowa, yeah.
Des Moines, West Des Moines. So
Okay.
that's where our new products are out there. But at 120 something bucks a square foot, Dallas Fort Worth, the main city, on the multi-story, brand new assets, I could never put them out of the ground for that in those markets.
Okay, so Dallas, you got to come in and swoop up the scenario, which people just have to accept the L now.
Yeah, I wouldn't build right now there because I couldn't. That basis has to come down. That's what makes them good, right? It makes them good because the basis is so low. Other markets that I look at where I go, if we're looking at pure just fundamentals, anything that we look at, we want high barrier of entry, right? And we want there to be a growth rate. And so that's where you look like California, that's the benefit of California. The barriers of entry are high. It's a nightmare to get it done, right? But if you have your expertise and everything and you can do it, it's like owning a monopoly because you're not worried about anybody coming in. Now, you have to pay for that monopoly.
100%.
But that's the benefit of it. So I like markets that have really good growth rates, but are just a pain. I mean, I do kind of specialty almost like when we're developing, there has to be a reason, not just market fundamentals and land. I'm buying up, like we did an office building, and the office building had a part of it that was a printing press. Now, because it had a printing press, because it was a newspaper company in it, it actually qualified under the zoning and regulations for storage because it was the same requirements to have a printing press in there. So we could buy it and put a storage facility in it, and they couldn't tell us no because it had already been zoned and everything that way.
This is the one in Idaho?
Yes.
I went to that.
Yeah.
I've been to that project.
Yeah.
Where's it at now?
So it's 65% full in a year. But the city would never let us build that, ever, in that location, right? And so that gave us a reason to go in there where artificially barriers of entry were high because of the regulations. That's the same with another place that we have in Idaho and also in Arizona. So there's unique attributes about that market that allows us to get in there. Those are the hardest deals to get done, right? They take the most time. It's difficult to get them out of the ground, but the protection and the upside on that is what you get in return. A lot of the deals that we're buying at low replacement cost today are in markets that are the opposite. So now our opportunity coming in is that we can get a great deal because they have to leave. Whereas if you look at, once again, 5 years before, I would have never, we looked at it, I couldn't buy in Dallas Fort Worth, I couldn't build because it just didn't make sense. And now we're able to go in and swoop up properties.
Right.
So,
do you think the challenge with the birth rate is going to continue?
yes.
Yeah.
Yeah. We live in a tale of two cities when it comes to the United States. Markets that are doing good are going to do really good. So markets that are doing bad, because it's all about migration in the United States now. Low birth rates, it's about where people are going, high migration, high barriers of entry. And what we're seeing in the United States, it's just the performance numbers, it's so different in certain markets. It's wild. And interest rates, the thing about interest rates when they go up, like Warren Buffett says, you don't know who's swimming naked until the tide goes out. We're seeing markets' true colors. We went through a 4-year period where you really didn't know what demand was because it was so artificially high because interest rates were nothing. Everyone was moving, building, capital was so easy, but that was not normal. And that was from the government putting those changes, printing trillions of dollars off. And so it made abnormal demand and everything looked like it was good. We had to come back down to earth to really see where demand was. And that showed us in a lot of those areas were really, really bad, but we didn't know until things came back down to earth.
Okay, so are you, because I get this question a lot from investors, is with where the birth rate is going, how is that going to impact things like housing or storage from an investment standpoint? Are you worried about that now, or do you think it's too far out to worry about?
No, I am worried about that now. At the end of the day, baby boomers, a lot of people talk about baby boomers retiring. My actual biggest worry is we have 75 million baby boomers and they're dying. So by 2030, we reach peak mortality rate with baby boomers dying. We are losing 10 million baby boomers in just the next few years. We will drop from 75 to 20 million baby boomers by 2035. We are not obviously replacing even close to that. We will have 10 million labor shortage by 2030 because we do not have enough people to take jobs. It's one of the reasons why today we have a labor crisis. We've never had interest rates that went up 4 times, and we did not see the labor market have mass layoffs.
Yeah, that was crazy.
The reason we can't because there's not enough workers. So this will be a persistent issue, but it will be exaggerated based upon where you live. So when we look at it, we go, okay, if you're in an area that has high amount, your average age is really high, you have no growth rate, people aren't moving in there, you don't have, babies being born, everything, the 10-year outlook for me, that is really concerning because where's the population going to come from? And so we're looking at areas where if you do have a high average age, there needs to be a really high growth rate. You need to have people coming in, you need to have younger people having babies, and that growth rate challenge in the United States is exacerbated by location. It's very independent though. Some areas over the next 10 years will perform really well and others are going to be devastated.
That's actually, I think, a good outlook on it. It's not going to be...
It won't be even across the board at all.
Yeah, and we usually talk about it in a way that it assumes all. It's very generalized how we speak about it.
Yeah. 90% of the markets in the United States I probably wouldn't touch.
That many?
Yeah.
Interesting.
Yeah. At one side, you have, it's not going to be a good market, but then on the other side, you have the supply-demand economics don't make sense. Right. So it could be due to the product. It could be due to the population, right? And it can due to the cost of entry. Right now, we have high cost to build. In good markets, you still have high prices. You have slowing birth rate. In most markets, you have negative growth. And those things all coming together make it so even if I could buy it, I wouldn't. I mean, we have deals that I wouldn't even buy, and I have a low basis into it. I'm like, this would seem on paper a great deal, but I'm like, I wouldn't touch it.
So on that note, do you think housing can solve itself solely by a lagging birth rate without building?
We have 21 million homes in the next 10 years that will come up because baby boomers will pass away. So we do have a point where the supply demand is going to change over the next 10 years. The problem is we're at such a shortfall that I think that just may help it not become catastrophic.
Well, I guess the question becomes who's getting the homes when the baby boomer passes away? Their children? And then
or they just sell it because the children are like, I don't live there. So if somebody lives in, Florida and their house comes and their kids live in Denver, the kids are just going to sell it. Right. They don't need it, right?
Right.
And lots of times the kids of the baby boomers, they already have a home, so they can't use an extra home.
Well, and also like when you have 3 kids inheriting a house, like it's complicated. So they're just selling each take their own share.
Yeah, you're usually selling it. I just wonder
how much of it will be absorbed.
Well, yeah, because let me ask you this. I have my opinion. Do you think the bigger challenge is right now the first-time home buyer not having the down payment or not being able to cover the mortgage? Down payment. I agree with you. So if the first-time home buyer, and I don't mean to say this without feelings, like I don't want my parents to pass either, but just from the financial standpoint, parents pass away, 3 siblings get the house. They're going to sell the house.
Yeah.
Now they have cash, and now they might have what it takes for a down payment. Are they buying homes? Probably.
Yes.
So now does... one parent own a house, 3 siblings are renting, parent passes away, They inherit it. Now all three have a down payment. Do now three people buy homes, and now you're net positive two? Is that what we end up seeing?
But
and so are
they're living somewhere. So if all three of them go to buy homes, you now have 3 vacant units.
Yeah, it just depends on what the unit is. Are they
Right.
renting a home?
So
Or are
is
they
it
renting
renting?
An apartment?
Is it exactly? So,
But wouldn't you argue that right now the percentage of people renting is too high?
Oh yeah.
Right.
Well, in comparison to what it's been in the United States. The United States, we came in the 90s, it became this big thing under the Clinton administration. Everybody needs to own a home. Like, that's the American dream. Everybody needs to. I actually have an issue with that. I do not think that that's reality. I don't think that everyone should own a home. First and foremost, not everyone is at a stage in life. So if you look at the population curve, how many people are under the age of 30 that don't have a career, that they're not married, they're not even in a place where they should own a home, right? So there's a segment of the population that they shouldn't own a home. They're moving, they don't have a career, they're not in that place yet, they should be renting, right? But in the United States, we would hopefully see where you got to that point, you had an opportunity to buy and own your own home.
So a pathway to it.
A pathway to it. That was largely dictated purely by financing models. So the government took the case that how we get people into home is we create financial institutions that will allow for people to borrow and drive down interest rates so they can afford it. That doesn't affect the actual problem with homes, and that is supply. That's it. Supply, supply, supply. We have had over 300% increase in regulation. 30 cents a dollar today, roughly 35 cents a dollar, goes to regulation in the cost of a home. It is so difficult to build a home. We have over 4 times the length to put a home out of the ground than it was 20 years ago. You have the cost to get that home out of the ground is now 4+ times higher. The regulation associated with HOAs, land, everything, it has gotten so difficult to build homes. That's not going away.
So why did that happen? Why did we turn into a regulatory state and then country?
What's happened really since after 1995, the United States changed dramatically. First of all, after 1995, the United States growth rate in GDP started to drop. But the wealth explosion allowed us to yield from this great bearing fruit that we've had. Institutions grew exponentially after this point. We're talking college, governments, admins exploded, healthcare, everything else, because there was so much money to be made. That outpaced, after 1995, the growth rate. So all of a sudden, the cost for the United States to administer abroad, everything surpassed a very key point. And that's where growth rate was declining, yet the actual administration, compliance, regulation, and cost was growing as if it was still booming like it was from 60 to 90. So that never changed. But the actual economic growth did. It went down by 50%. Regulation went up by hundreds of percent. And that just stagnates a market when people aren't actually netting more money. Regulation is coming in much, much higher. The cost of it is much higher. You just stagnate and the wheels on the machine start to grind to a halt. And we've seen this in housing, school. We've seen this in a really big way when you look at medical. And those costs are killing Americans. The cost of home ownership, the cost of college, and the cost of medical care are the 3 main drivers that are killing Americans. When you look at things like inflation, actual goods have gone down a lot. So your grocery bill compared to what it was 20 years ago is half, right? Your products and technology, everything else has gone down. But the main things like housing, medical, school, things like that, that's exploded. And so now they don't have excess cash. And that's created an environment where we can't afford it, and we can't even get it done. I can't put new supply out onto the market because it costs so much to do it. The risk doesn't make sense anymore. I was talking to a developer, this was back in 2021, and he's the largest developer in multiple states. And he said, AJ, in 2008, do you know how many homes that I had that were out ready to be sold? And I'm like, I have no idea. right? And he's like, it was like 650 at any given time were ready. And he's like, do you know how many you have today? 4.
Wow.
4. We will not build until they're ready to sell because the cost of the land improvement and the cost of building had gotten so high that paying laborers and contractors to go out and do it, if we don't know that it can sell, that's too much risk and we're not going to do it anymore. And so they won't go do large swaths of land approval, put out large amounts of homes unless they know it'll sell.
Right.
And so we have a supply problem, and that's not going away unless we just lower those barriers of entry, open up the floodgates for not just people to build a home. We need large developers to go back to a time when they were buying massive swaths of lands to build huge suburbs, which put so much supply in the market, it just lowered that cost of homes. And that's not happening.
Okay, so one of the major levers we could pull right now is deregulate. That would help, right?
That would help a lot.
Some states you are seeing it,
Yes.
right? It's just not.
Texas is a perfect example.
Yeah.
The cost of regulation is a fraction
Right.
in Texas of what it is in California.
And time.
And the time to get it out, it's literally, I think it's 1/4 of what is California. California's housing cost problem is a supply problem, where Texas, they've had a growth rate that is multiple higher than California, yet the cost of homes have not increased like it. So it's a perfect case study that when you can build cheaper homes and you can put them out faster, there's less barriers of entry, the costs get driven down massively.
Okay, so then why do you think the politicians in California don't see that and are willing to deregulate to bring the cost down?
So I think there's a few reasons. Whether it's California or other areas, there comes a time where politicians aren't economists, right? I think most of them, they do not understand. And there comes this default to where they just say, oh, it's greedy developers.
Right.
And now they're literally fighting with the very people that supply the product that your people need. And that relationship is not good. They need to work hand in hand. And I think that's now starting to be realized. I think people are now realizing, and governments are starting to go, oh, we need more houses. And it doesn't matter how many subsidies we give to people. If they have no homes to buy, a subsidy doesn't matter, and the market will keep driving up prices. But they're realizing that after 30 years of making it harder and them thinking we can subsidize housing and that will take care of the problem.
Yeah.
You can't subsidize a house that costs 3x more to build to a point where it is back to what it cost.
Yeah.
It doesn't work.
Yeah, that's right. So this report just came out in Santa Barbara that it was a 4-3 vote on the city council to freeze rents.
Yeah.
And 3 weeks prior to that vote, I was speaking at a big housing conference up in Santa Barbara, and there were elected officials in the room. And I basically said what you just said. The elected official can't be at war with the developer, and the developer can't be at war with the policymakers. You have to come in alignment, because without alignment, nothing gets built, and you can't just offer subsidies to get us out of this problem. And I left there so encouraged. I'm like, okay. Like, I spoke to some of the elected officials. It seems like they understood it. They can't be speaking past, the developers and vice versa. And then I saw that vote. I'm like, oh, it didn't land. Now, hopefully the 3 that voted against it were the 3 in the housing conference. I don't know.
Yeah.
But I would say I agree with you. I think it's been long enough doing it one way. The pain point for all the people is great enough that the politicians are listening. And now I think there just needs to be more and more examples of other cities thriving, where the cities that aren't, hopefully elected officials go, okay, we need to change course, or hopefully they get elected out. Like
the people are getting more educated. I think the people are looking at it. It used to be, people were like, housing costs so much. It's this dirty developer, right? And then officials got elected by going after them. And so that became their platform, right? And then they found after years of doing that, I think the average person is like, there's no homes. And I now realize I can't get a home that's cheap because there's no supply. We need more of that. And so then they'll put pressure on the elected officials to say, get more homes built.
Yeah.
Cut the red tape, do what you need, because we need more homes built. Then the elected officials will change their tune because then they'll get kicked out of office if they don't. But it takes the people to put that pressure on them, where that came from the other way. Another problem you have, though, is NIMBY. So, you got these people that are out there going, I have a home, I like my home, and I want you to make sure that everything looks like this, and I don't want new development. I don't want homes that don't look as nice as mine. And we're going to put pressure on political officials to keep things the way that I like it. And then that becomes, because they're the voting base, that actually becomes the driving reason.
Well, they're the loudest voices.
They're the loudest voices. Then all of a sudden, everybody else gets slammed. And there's no new houses, but the people that own a home, they're happy with it. Why? They have equity in their home. Yeah, my house went up 5 times in value. That's good for me. And I don't have to worry about lower homes coming in and price homes because I think that'll affect my value. So they're happy, but everybody else is getting screwed.
Okay, so let me be devil's advocate for a second.
Go for it.
If the elected official is elected to represent the voice of the people, and the voice of the people say, nope, we don't want any more housing.
Yeah.
Is it the elected official's job to follow the will of the people?
Absolutely, if that's the majority of the will. The problem is, I think it was when you had interest rates that were free, the cost of housing could go up. Interest rates go from 6 to 0. That means housing costs could go up and we could still afford it.
Right.
The moment interest rates went up to 8, now the cost of the housing is actually the driving thing. So now the voice of the people has changed.
I actually think there's
sense.
a flaw in your premise.
What?
I don't think it's the voice of the people. I think it's just the voice
agree.
of the. I think it's the
Small
loudest
amount.
voices
Yeah.
of the smallest minority of the people that are garnering the greatest amount of attention.
Okay, that's fair, but just for the point, what if it is the majority?
And there is some areas where that is, and they want their area to be like that.
Where.
No, that's not what I'm saying. I'm not talking about a specific area.
Well, yeah, hypothetically speaking, sure, but politicians have generally acted in what is the greatest incentive for them to keep their job.
Right.
Yes.
By a large. So these
You're
people that
you're
are
making
hurting.
the point that if we're just talking about the NIMBY group specifically, they're so loud that you think they're the minority, but because they're loud, the politician thinks that they're the masses.
Well, and I
majority.
don't think the politicians have any consequences, at least in California, have not had consequences for doing the right thing. Doing the right thing meant that they would potentially lose their seat because the NIMBYs would go out
Yes.
and rally against
And
them.
Okay,
fund.
but that's the point I'm making, though. It is doing the right thing, voting in accordance to what the people who elected you want, or is it going against them and doing what you believe is right? I guess that's the question I'm stacking.
Yeah.
And at the end of the day, it becomes a balancing act because there will always be groups of people that they already own the homes. They're okay because there are equities in it. They don't need to buy. Interest rates don't affect them because they're locked into 30-year mortgages, right? Versus the people that don't, they can't afford, right? They can't have new houses. And you're talking about short-term versus long-term problems. And that's what's happened.
Yeah.
In the short term, those louder voices made sense at the detriment of a long-term community and long-term affordability. Because the price imbalance of supply and demand only occurs after the imbalance has occurred. So by the time that it's there, it's too late.
Yeah, that's a good point.
I actually think there's another problem to this, which is people stop paying attention to local politics.
I'd
that's
agree.
fair.
100%.
People are so focused on national
Yeah.
and federal that they're not realizing that the things that affect them the most is what's happening
Oh, absolutely.
locally.
Yeah,
Local
that's
right.
politics
And so it's
is where it matters.
People need to get involved in their local politics. They need to
Yes.
see what's going on in the city council. Because people that are feeling these pain points, the NIMBYs are all over it.
All over it.
Right? They're the ones that are going to every meeting. They're the ones that are speaking at all of them. And the overwhelming majority of the people that don't necessarily agree with that, they're just kind of living their life. And they're not paying attention to what's going on locally. But if they start doing so, they can effectuate change in a much bigger way than I think they can.
Well, and two, you have another problem that, okay, so you got a developer that's coming in. And, we've seen this. A developer comes in, goes to city council, and you're worried the city council is going to get murdered because a developer is there trying to propose something. The new houses that they will build are for people that don't live in them. So you're talking about building homes for people that are not yet there, right? And the people that are there, and even though the city's growing, And you got that imbalance. They're rightfully so trying to protect their properties. And it's not that that's wrong. There needs to be this balance, right? But you're talking once again about future versus today. If you take a large development of, let's say, a housing community that would add a huge amount of supply of homes to an area, that is years out. But if you don't do those things, years later, the imbalance is so big, it crushes the residents.
Yeah.
And so there is this problem with long-term versus short-term. And once again, developers being the bad guy, they come in to propose something. The city's like going to murder them. And the city council is sitting there as people are screaming in these rooms. And they're like, okay, yeah, we're not passing this. But then you get to a point where those same people are screaming, we have an affordability problem. So a lot of, and I'm just going to say it, a lot of people, they want their cake and eat it too. I want housing affordability, but I don't want you to change what you're building or how much you're building. And I want it to look and be like this, which is the highest cost of housing. This relationship has always been hard. But when you add on regulations and barriers of entry, it makes it so the people that put out houses are like, it costs too much to do it. I'm not taking that risk. And then they walk away. Because now the cost of it is so astronomical and it's so difficult to do, they're going to go elsewhere and they're not going to do it. And then how do you get out of that?
Right. That's right. All right. So you heard it here first. Number 1, get involved locally. Number 2, make decisions for the long term. Number 3, all AJ's links will be in the description. If you want to follow him and learn, that will be available to you. If you are interested in investing in storage, that will be available to you as well. AJ, thanks so much for coming on.
Thanks for having me, man.
Ooh.